And this is my price action trading course. This module has to do with reversals. When the market's in a trend, it's moving mostly in one direction. For example, in a bull, it's moving up, and in a bear, it's moving down. And when the market is in a trend, it's always contained in a channel. A bull trend forms a series of higher highs and higher lows, and it's contained in a rising channel. The bottom of the channel is the bull trend line. A bear trend is a series of lower highs and lower lows, and it's contained within a falling channel, and the top of the channel is the bear trend line. You should always be looking for support and resistance. Although most resistance fails to stop a bull trend, all bull trends end at resistance. And although most support fails to stop a bear trend, all bear trends end at support. So you should be paying attention to support and resistance and watching how the market behaves and seeing if there is a reversal pattern there, if the context is good and the signal bar is good for a trade in the opposite direction. A reversal, simply a change from one trend into an opposite trend, bull into a bear, bear into a bull. First step in all reversals is breaking the trend line, which is a breakout from the channel. So if you have a bear trend, the first step is breaking above the top of the channel, which means breaking above the bear trend line. The next step is a series of lower highs and lower lows. So if you have a bull trend turning into a bear trend, instead of making higher highs and lows, you're now starting to make lower highs and lows. If you have a bear trend making lower lows and lower highs, and it's turning into a bull trend after it breaks the trend line, you want to see higher highs and lows. You want to see the market start to trend up. Some traders only trade trends. They don't want to trade reversals because the probability within trends usually is high, 60% or higher, that the trend will continue. The risk, however, is often greater because you usually have to use a wider stop, and that's the price you pay to get the higher probability. The rewards also will be at least as big as the risk. Whenever the probability is 60%, usually the reward is equal to about the risk. Other traders only want to trade reversals because they see the potential reward as much, much bigger than the risk, and they're willing to accept a lower probability of success to achieve that very big reward. And there's no right or wrong. Both are acceptable ways to trade. Remember, most reversal attempts fail, and ultimately most reversal attempts become trading ranges and not trends in the opposite direction. Even when a successful reversal trade occurs, usually the reversal results in a big trading range instead of a trend in the opposite direction. But the opposite move usually goes far enough to at least make a swing profit. All reversals actually are some type of double top or bottom. A reversal always involves some kind of a test. So if the market is going up and it reverses, there probably was a test in there and some kind of double top if you look hard enough. Most reversals involve some kind of a trading range as well. All bottoms are variants of double bottoms. All tops are variants of double tops. But very often some other term is better used to describe what is going on. Sometimes the double top or bottom is so distorted that it's hard to see, and it's usually better described by another term, like a final flag reversal. V bottoms and inverted V tops do not exist. Every instance is something else, usually a small final flag or a wedge. So at the extreme, you could say, hey, there's no double top here. Well, in fact, the market had a top here, a pause, and then it went up for 5 more bars, and this was simply a test of this high. So this reversal, even though it does not appear to be a double top, it is a variation of a double top. The market tried to go down here and then exploded one more time to a new high and then went down again. So even though you might call this an inverted V top, to me the market went up and then had one more climactic top. So this is the second top following this top. There's also a larger final flag here, and this was part of the topping process. It was accumulating selling pressure. Here's an example of a V bottom, but actually the market tried to bottom here. We had a bear breakout, and then we had a couple bars with tails, an attempt at a micro double bottom. Even though this bar did not go above the high of this bar, this attempt at the bottom was the first bottom, and then we had a second bottom here. So I would not use the term inverted V bottom. I would say that this is a small final flag reversal. It also dropped below a trend channel line and reversed, so it's a small wedge as well. But my main point is that it's at least two attempts at a bottom. The market tried to bottom here, broke to the downside, and tried to bottom again. So it's a variation of a double bottom. On this chart as well, you can say, well, where's the double top over here? It's a higher high major trend reversal. There's a trend line break over here, and then a new high. Well, it's actually a double top with this high. The market tried to top out here and failed. It had one more push up. So this top is actually a double top with this. All higher high major trend reversals are some variation of a double top. You can also argue that it's a double top with these highs as well, or with even this high, potential final flag. The market it pushed up here, tried to top out and failed. It had one more push out up, and then it succeeded. Most reversal patterns are trading ranges. For example, major trend reversals usually usually occur within trading ranges. Major trend reversals are variations of double tops and bottoms, which is a sideways market. Final flags, a flag is a trading range. Other failed breakout patterns and climaxes usually involve trading ranges. Wedges, usually part of a trading range. Double tops, double bottoms, triangles. These are all potential reversal patterns, and they are trading ranges. Head and shoulders patterns, tops and bottoms, they are trading ranges. Rounded tops and bottoms are trading ranges. A climax is usually a failed breakout from a trading range. Every reversal pattern will be discussed in its own module over the next series of modules. And this is the end of this module on the introduction to reversals.